Hey guys, when starting out, moving averages can be so complicated to wrap your head around because there are so many of them and you don't really know which ones to focus on, right? We have the exponential, we have the simple, and then people watch a plethora of them between the 20, 50, 150, 200, 300. Sometimes for the EMAs we have 9, 21, some of them are 20, 40. Just way too many of them, so which ones should you be focusing on? So the most important thing to note is that frequent times people refer to moving averages as the daily moving average, for instance. And if you guys will set up a 50-day moving average on one chart and then navigate, let's say, to the 1 hour chart, that moving average is just going to turn into the 50-hour moving average. You don't need to do anything else. You don't need to try and tweak the settings. The charts automatically update that for you. So don't worry about it basically, but keep an eye out for them and try to understand how the different moving averages work for the different charts and which ones are important. Now, what I would like to mention here is that you guys absolutely don't have to understand how these are getting calculated, and they are getting calculated based on the end of the previous day or the previous hour, right, as we go along. And so all you need to know is the difference between simple and exponential. Basically, for exponential, they're being weighted on the more recent price movements. And so, for instance, if you would put together a 20 simple moving average and the 20 exponential moving average, the exponential would move much closer to the price action and make things much more responsive to the way that the price action is moving because it's heavier weighted on the most recent price action. So which ones should you guys be using in the first place, right? Well, honestly, there are so many strategies out there that I really encourage you guys to find something that works for the stocks that you are using, for the timeline that you're watching. And then in the first place, I definitely recommend that you start getting used to the 50, 150, 200 and 300 day moving averages, because most people use moving averages to dollar cost average into long-term positions, right? So if you're somebody that is looking to dollar cost average at different thresholds that make sense for your portfolio, I would probably be having eyes on important stocks like maybe Microsoft over here, we're looking at it, and keep looking for the 200 and 300 day moving averages, which on this chart over here would be the green and the brownish yellow thing over here. And I would probably dollar cost average every single time the stock would come down to these levels. Now, obviously, we've been going through a bit of a rough patch for stocks, and so the moving averages are above the price action in this case, so we wouldn't be looking to add based on the moving averages or based on the 300 and 200. We would probably be looking at price action and trying to understand if we're starting to form a bottoming pattern and be able to add to our stock, or maybe not. You know, there's a huge debate of whether or not this is still a bear market rally right now, roughly in December 2022, or whether we're going to continue seeing more downside. So it all really boils down to your horizon, guys, because if you're looking at maybe 1 year's horizon or 5 years horizon for your investment portfolio, then that's one thing. If you're looking to day trade or swing trade, that's a completely different ballpark. So something that I recently learned from a hedge fund manager would be that, for instance, on the 1 hour charts, the 20 moving average really moves sort of in sync with the price and makes it so easy to try and follow it. Sure, I'm using it mostly on forex and sometimes on the indices. I'm not using it for stocks as much, but even for stocks, you guys can see that I've just turned, by the way, my blue one here from a 50 to a 20, and you guys can see that it's definitely offering some sort of a support resistance indication whenever the stock price moves below or above this moving average. And so this is exactly what I'm talking about, guys. I would definitely recommend that you try out different types of structures, different types of moving averages to identify which ones make the most sense for the stock that you're watching, for the strategy that you're using. I'm gonna turn off my moving averages and activate my exponential ones because I want to show you guys the setup here as well. So first off, I'm using a 9 and 21 crossing or crossover for whenever I would like to trade really short term. So in this case, I would probably be moving on the 5-minute chart, and you guys can see that every single time a 9 crosses over, and for what it's worth, I've also seen a lot of people use the 8 and 21 crossover. So you guys can see that whenever the 9 crosses over the 21, usually we have a pretty important rally occurring, both on the upside as well as the downside. Now, it's not always happening and it's not always getting validated, which is why it's important for you to wait for confirmation, but still the crossover makes sense, right? The 40 is really something that I use for the daily charts, because for the daily charts, if the 20, which is well, I don't really have the 20, never mind. I have the 21, which is the purplish one. So I guess they compare, or they're very close. But whenever the 20 is above the 40, that establishes an uptrend. Now, for the moving averages, for the simple moving averages, it's kind of the same. We can also use those to establish what the trend is, right? So in this case for Microsoft, we have the 50 below the 150, which clearly defines a downtrend. If the 50 would be above the 150, that would be an uptrend. On price action is still the most important, but moving averages make a lot of sense, and they really help us understand kind of what the history of that price movement looks like and where we are most likely to identify support resistance zones. Now, the way I tend to use these and why I've gotten the ones that I just mentioned to you guys is because I've done a bunch of research and I've kind of identified which ones are the most used. At the end of the day, that's kind of what matters, right? If you can identify moving averages that a lot of other traders use, especially institutional traders, and then if you can replicate buying when they buy and selling when they sell based on how the moving averages move around the price or the price around the moving averages, then it's gonna be a lot easier for you to find more consistency with your trades. If you took anything out of this video, guys, please subscribe, leave a thumbs up, and if you are looking to find more consistency with your trading, please check out these guys here. They're called ARCISFX, and they are offering live day trading signals to buy and sell different positions in different stocks, commodities, forex, you name it. Honestly, guys, there's nothing to lose because there's a 7-day free trial. You can try it out, and if you can make money with the signals that you're receiving, then give them a try. It's a monthly commitment, cancel anytime, and they've averaged 9% last month, guys. Check out this video over here if you're looking to learn more about the stock markets, and I'll catch you next time. Take care.